I assume everybody's back. It's 11 o'clock. This is the final paper in the session, as well as our 3 days of well, not 3 days, but 3 sessions of corporate finance here at ABFER. It's my pleasure to have Frank to present his paper on the IPO in evidence from China. So let me before Frank starts, just let me talk briefly about the papers that are on this session, as well as the other 2 corporate finance sessions. We have made the conscious decision of having more Asian papers in the program, and as we have seen the previous paper, and I'm sure with this one, I think the Asian papers clearly have generated a lot of interest. There are some lessons that we can learn specifically from Asia, but I think it's true across the world. Like I said earlier with my comment about the Medici popes, I mean, these things is not specific to Asia. I think this is really a global phenomenon, but we can see it better in using Asian lens. So Frank, without further ado, the floor is yours.
Mm-hmm. Thanks, John. Thanks for organizing a great session and sharing. Of course, I'm very grateful for the ABFER conference in general. I've been very privileged to attend it. I think since the inception. I'm co-authoring the paper. Did this paper with Mark Spiegel of the Federal Reserve Bank of San Francisco, who is on the call, I believe. And the usual disclaimers apply. The results reported and implications we draw are not related to any policies or opinions of our employing institutions, whether it be the Federal Reserve or the BIS and its Asian office in Hong Kong, which is, by the way, that office is in the 78th floor of the tall building you see on this slide. But so what's our paper about? It's really about the effects of IPOs on already listed firms. And there are two channels stressed in the literature. One is the direct competition for firms in the same industry. If a competing player raises the funds and gains the profile that comes with an IPO, that's not going to be good news for firms. Another channel is competition in asset space with firms whose equities have common risk characteristics. And this is developed in a famous paper by Brown and Lorraine, RFS 2009, looked at IPO privatizations in emerging markets, and saw the impact was greater on those securities with similar return characteristics. So the background and motivation for our work here is studies of competitive IPO effects are a problem is posed by the endogeneity of IPO listings. The firms deciding to go public may be revealing that they think that the market is topping out, or particularly the market for their sort of firms. And that can be thus bad news independently of the competitive effects discussed above. So what we are looking at are blanket suspensions of IPO activity by the China Securities Regulatory Commission, CSRC, that present a natural experiment of sorts, allow us to get around this endogeneity issue when examining the effects of IPOs on listed firms, or, as Johan said, the effects of non-IPOs on listed firms. But there's no reason we shouldn't expect the effects to sort of be similar regardless of the sign. Our panel spans 3 suspensions of activity, and which allow for controls in the macroeconomic conditions at those different points in time. Different suspensions reflected different conditions, but at the same time, this really gives us a nice cross section of responses to suspensions of IPOs. And let me go into that further. Just to preview our results, They indicate IPO competition from both channels matters. As for direct competition, suspensions disproportionately benefit listed firms in industries that are heavily represented in the queue of firms that's approved to go public. We also find that what we call assets-based competition matters. Firms with greater covariance in historic returns, with a synthetic portfolio replicating the industry composition of these suspended IPOs, they earn higher returns on the suspension announcement dates. At the same time, and this is an aspect of the findings that we really want to emphasize, there is heterogeneity in the sensitivity to announcements. Equity responses to the suspension announcements are dampened for more profitable and productive firms. They're less affected by the IPOs that don't happen. And by extension, by IPOs that do happen. Profitable firms, by a number of measures, are more resilient and less affected by IPOs. And this is consistent with the literature, Su et al. In particular. So where do we stand in relation to literature? I mentioned it briefly earlier. There's a literature on the impact of IPOs on existing firms from the competition channel. There's a very recent one in RFS by Spiegel and Tukes, but that's not our Mark Spiegel on the call. That's a Matt Spiegel. And there's also this asset-based competition, and there's some papers, Hong et al., and then the Brown and Lorraine I mentioned earlier. That channel, endogeneity of IPOs I mentioned earlier. That goes way back, and of course Jay Ritter, among others, has pointed that out. There's more recently some literature on the impact of these suspensions. We're not the only ones who noted that these provide a nice natural experiment of sorts. Song and Howell have a MBR working paper where they look at the effect of suspensions on the firms that didn't get to go public as opposed to those firms that are already public. She et al., there's a JFQA paper, also looks at the suspensions. We've relied on this JFQA She et al. Paper for dating the suspensions. So part of the paper, it covers sort of institutional details about the suspensions. What was going on, though there hasn't been suspension since 2015, and often, say, Mark and I sort of wrote early on this in an economic letters of San Francisco Fed, and so sometimes we've joked among ourselves that maybe they don't do it anymore because of how our results that we presented earlier. But there's a fear at that time that new IPOs would lower liquidity or depress market prices, and so they would call off, suspend IPOs. At that time, the suspensions were a surprise as far as we could tell. People were not predicting them. There weren't predictions in the literature or in the media. The duration was indeterminate when the suspensions were announced, and has been variable. The realized durations 2809, 214, 1214, 438, 150 days, respectively. They've been variable, and the Song and Howell paper I mentioned earlier, they've documented how they've been costly to firms in the queue in terms of the firms that didn't get to go public. This was costly in terms of R&D and innovative activity. The suspensions had mixed effects as far as we can tell in lifting the overall market. So again, our focus is not the overall market, it's the differences in the returns among various companies. The three suspensions examined in the study are quite mixed. Let me just go quickly to the chart. In 2809, the overall market, the Shanghai Stock Exchange Composite Index, rebounded during the suspension period. 2012, 14, the shaded area is the length of the suspension. The market remained fairly constant. In 2015, share prices continued to decline with a partial reversal later. So another part of our paper describes the IPO process for individual firms. We need to walk through this a little bit, and we do in the paper. And at least this is the process during our sample periods. It likely has evolved, and we know it's evolved since. But it's a series of steps: preliminary review of the CSRC application that can take years, formal assessment by a stock issuance examination verification committee, the application at a domestic exchange within 6 months. That's more of a formality. The firms and underwriters build a book, conduct a roadshow, and decide on a share subscription day. That's somewhat similar to we've seen in other countries. After subscription, it's an average of about 4 weeks for the shares to list. And in total, the time between approval and listing averages around 3 months, but intervals between 2 and 5 months are common in normal period. So this is what gives our study, some power. There's a queue of firms that are waiting to list. So when the suspension occurs, these firms are hit. While most of them eventually go public, they're delayed, and as I mentioned, there's a cost to those firms. Now, this IPO approval process sort of facilitates the identification. And here's how. Ahead of the suspensions, there were 30, 66, and 62 firms that have been approved for an IPO. We're waiting to go. 158 total. There is considerable variation across these Q firms in the IPO size, more than 3 billion in RMB in 2008, which I don't know exactly what the exchange rate was then, but around, just to give you some numbers for those of you familiar with the U.S. literature, $400 million US dollars. More recently, the IPOs were smaller on average, around 0.4 to 0.6 billion RMB, 80 million USD. Now we have dummies that control for the differences in the impact of expansion of the suspensions, as well as the market and economic conditions at the time of the suspension announcements. Now, importantly, the Q, is public knowledge. The industry affiliation of the delayed firms is thus public knowledge, and that allows us to calculate which industries were more affected by the suspensions. We can calculate sort of what percent of the industry market calculation these IPOs that were in the queue would have represented, and this gives us a variable that will differ across listed firms. Excuse me. Okay, here's some summary statistics that I'm just talking about. There's a difference in the size of the postponed IPOs. There's differences in length of suspensions. We've talked about the queue, but what about our sample data? Now here are the sample data. The base sample is the pooled data of listed firms. The queue is explaining the return, in various permutations how we measure it, but that's helping to explain the returns of the listed firms. At the time of suspension, listed firms on Shenzhen and Shanghai stock exchanges gives us more than 645 observations total. Dependent variable is the one-day return on day T, the closing price of the previous trading day. The suspensions are normally announced after that previous trading day. Though as I mentioned later, will be mentioned later, we look at 2-day returns. We look at returns net of market. Doesn't really matter. There's two two explanatory variables of particular interest in our investigation. One is an industry level measure of potential delay in direct competition, which is of the potential delay, which is the expected share of firms from the listed firms industry in the queue. We use realized values of IPOs when the firms eventually go public, which is later after the suspension. So the measure implicitly assumes that the market expectations are for the size of the IPO are unbiased. There's the proxy for potential competition in the asset space is based on the covariance that I mentioned before of securities with the synthetic portfolio of firms with an industry matching delayed IPO queue. So we know the industry composition of the queue, and therefore we can come up with a synthetic portfolio, and then we look at the covariance of each security with that. That's an individual firm measure. We calculate, and as mentioned, it's the weighted. It effectively amounts to the weighted sum of covariances between the monthly firm or each firm with the monthly return in each industry, and the weights are determined by the queue. We also interact measures of IPO competition with indicators of profitability. So the health of the firms affects their resilience. We use 5 different profitability indicators just to check the robustness. Net profit margin is the one that we show most of the time with the robustness checks, but the returns in general are quite robust to changing this measure to return on assets, return on equity, invested capital, OROC. Other conditioning variables in our setup: market capitalization, leverage, price to book, earnings volatility, also state-owned enterprises. We put in a Shanghai exchange dummy. It could be either Shanghai or Shenzhen, so we put in a Shanghai exchange dummy. And we also include time dummies, as I mentioned earlier, to control for differences in the macro and overall financial conditions at the time of each suspension. So what's our specification? The base specification is what let's see here. We have an indicator of the firm performance, listed firm performance on its own, but it's also interacted with these 2 channels of potential competition from IPO activity. IPO is basically just the share of the Q firms that are in that industry, and covariance is the proxy for assets-based competition. So there are 4 primary. Let's just going down to the second bullet here. There are 4 primary variable coefficients of interest. Then the importance of the direct competitive effect of IPO activity are measured by the sensitivity of the one-day returns to the eventual value of the IPOs in the industry that were in the queue at the time of the suspension. So that's B2 in this regression, in this equation you see. And then it's adjusted by the sensitivity to for firm performance. They're measured by sort of interacting the IPO with net profit margins. So that's B3. Similarly, the importance of the assets-based competition effects of IPO activity are measured by the sensitivity of the one-day returns to the covariance of the returns of firm I in industry J over the previous 3 years with the returns synthetic portfolio. So that's B4. And the estimated adjustment of that sensitivity for firm performance, here measured by interacting it with the net profit margins, B5. So those are the key explanatory variables and coefficients of interest we estimated with OLS and standard errors clustered by industry. So the base specification results, where each column interacts the competition channel. We have different measures for health of firms. So that's each column. There's net profit margins, return on assets. But then we move down. IPO is the Q share effect. That's the direct competition effect. IPO times PI is how much that is ameliorated by if the firm is strong. COV is the assets-based competition effect. COV times PI is how much that's ameliorated. And here you see, just in general, we're getting the right signs and statistical significance, regardless of the metric we're using for firm profitability or firm performance. The point estimates also show economic significance. A 1 standard deviation increase in this IPO, or the market share, the direct competition metric, that increases the returns by 24 basis points. And the point estimate on the interactive term suggests at the average IPO direct competition level, if the profitability is up by 1 standard deviation, that effect is ameliorated by around 6 basis points. Stronger firms are less sensitive to suspension news, all else equal. The assets-based competition effect also enters at statistically significant levels with expected positive sign. 1 standard deviation in this COV variable increases the returns by 43 basis points. So results are robust to use of other performance proxies. They're also robust to adjusting for a period of time that firms were in the IPO queue at the time of the announcements. And this is something we spend a fair amount of time looking at because firms that have been in the queue for longer, you could argue they should experience a greater adjustment to their IPO timing because they would have been more likely to go public quite soon than those who had not. So we spend a fair amount of time in the paper looking at what if we adjust for this potential heterogeneity in the news content of the suspension announcement. So we weight the IPO variable for each firm in the queue by this realized period of delay, and the results are quite similar. So that's pretty much it. The rest of the paper is about considering changes in specification, considering changes in sample. We drop different conditioning variables. We drop interactive terms. Here we go. Results are generally robust, though we've noticed that when you drop the interactive term, you can get some problems with the signs of the main term. And our interpretation of this, it demonstrates the need for allowing heterogeneous response across firms, depending on their underlying strength. We also do changes to the sample. We look at SOE firms only, non-SOE firms only. And when it's SOE firms only, the results carry through pretty much unchanged. Non-SOE firms, the COV variable is, and interactive terms are both insignificant. And we conclude that both SOE and non-SOE firms face exposure to IPO activity through the direct competition channel, roughly the same magnitude, but while the SOE firms appear to also face potential competition through the asset-based channel, we don't find evidence of this channel at work for the non-SOE sample. Model 3 and 4 in this table, we divide the sample into Shanghai versus Shenzhen. There have been a fair amount of Shenzhen firms recently. They tend to be higher book market to book and more tech. But our results in the base specification shows that while Shanghai firms enjoy modestly similar or modestly better returns, the results on the key variables are basically the same regardless of exchange. And just to take some other models, we drop extremely, or some other samples, we drop extremely profitable and unprofitable firms, and we don't find the results affected that much. Again, with this exception of the interactive COV term with profitability, that of the four main coefficients I mentioned earlier, that's the one that's the most fragile. Here again are some more changes to the sample with the earlier results. Again, assets-based competition matters, particularly when it's in its interactive form with firm strength. We just find less strong evidence that the difference between profitable and unprofitable firms makes any impact on COV. We also, as I mentioned, we look at as I mentioned earlier, the adjustments for delay. It's all in the paper. I don't know if some of you had looked at the paper when it first was posted. We posted a new version with a few changes. Of course, our Discussant has the new version. We posted that a few weeks ago. So if you wanted to look at it again, that's you can go back to the ABFER site. But this is just some other changes to the method or the sample, and the results are pretty robust. And I think given the time, why don't I go straight through to the conclusion here? We've evaluated the impact of IPOs on listed firms using the experience of the Chinese suspensions of IPOs. We argue because they're unanticipated and they've applied to the entire market, they provide a good natural experiment for estimating the impact of IPOs on listed firms. We find positive evidence for two sorts of competitive effects that have been emphasized in the literature to date, both the direct, what we call the direct, and the asset-based competitive effects. And they're robust to a wide variety of sensitivity checks. And really importantly, we also find evidence of heterogeneity in the sensitivity of listed firms to this suspension news. Namely, better performing firms benefit less from the suspension. They're less exposed to IPO risk, put it that way. And this particular finding is also robust to a wide variety of sensitivity tests, with the caveat of we have less robustness for this interactive asset space term. So I will leave it there and look forward to Tianyue's discussion. And again, Mark is on the line too, so we may both be talking later on.
All right. Thank you, Frank. The discussant is Tianyue Ruan from NUS. Tianyue?
Okay, so please let me go ahead and share my screen. Okay, so here's my slides. I hope that everyone can see clearly and also hear me talking. So thank you very much for this opportunity to discuss this very interesting paper. I enjoy reading it, and I enjoy the opportunity to think through some of the issues that have broader implications. So first, let me quickly summarize what this paper does and what it finds. So this paper is pursuing this question, how IPOs affect already listed firms. So theories and prior research suggest that already listed firms may be affected adversely through two competition channels. The first one is a direct competition, and the second one is asset-based competition. IPOs have been around, and there are a lot of IPO research. So previously, the IPO literature has also tried to pursue these questions, but most of them use what I call the conventional approach. Basically, what they do is that they will examine already listed firms' returns as well as performances around either successful IPOs or IPO withdrawals. But this approach is subject to, I think, pretty obvious endogeneity concerns. The first one is the endogeneity of who does the IPO or IPO withdrawals. We know that it's not a random sample of firms who choose to IPO or withdraw their IPO plans. The second endogeneity is about when the IPO or IPO withdrawals take place. So there's I would say a pretty long literature documenting that firms that want to raise capital in the public markets, they sometimes will want to time when they do the IPO issuance. There has been work showing that when the industry, a certain industry is likely to be overvalued, there will be more firms from this industry that are trying to do the IPO by riding on this overvaluation. And similarly, IPO withdrawals take place much more often when the market valuation dips down. So this paper uses this very nice setting of IPO approval and suspension in China. I think Frank already explained the setting pretty clearly. Let me just summarize what I think is important for us to think about the implications. So first, firms in China, they need approval from CSRC or the China's SEC to do the IPO. This is very different from the US system that is based on disclosure-centric regulation. And getting approval can sometimes take years. So it's actually a very lengthy process. And in the past, CSRC has done several blanket suspensions of IPOs that basically force the firms that have already obtained approval from CSRC to delay the IPO plans. So here are two graphs I borrowed from Chong and Howell, which studies the IPO suspensions to these delayed firms. As you can see in this panel, each of these dots is an IPO firm, and the horizontal axis is the approval date. And these two shady areas are the two out of the three suspensions that Frank and Mark has studied in their paper. We do see that just before the suspensions, these firms that received approval prior to the uninspected suspensions, they need to wait much longer. Why? Because even though they already obtained approval, and even though usually the approval to listing is only a couple of months, when they face the blanket suspension, they need to delay. So no IPOs take place in these two shady areas. As this panel shows, they need to wait after the IPO is permitted again after the suspension. So this is the setting in China. So using this very nice setting, which has a couple of advantages that can help us overcome the two endogeneity concerns, these papers studies how it affects already listed firms. It focuses on the one-day return on the announcement date of the IPO suspension, and it uses the cross-sectional variation in the industry composition of these delayed firms. So it come up with both measure for direct competition by the value share of these postponed firms in a certain industry, as well as a measure for asset-based competition, which calculates historical covariance with the portfolio of listed firms that are in the same industry mix as postponed firms. And the paper finds that the IPO suspension is beneficial for the already listed firms. This is consistent with the competition channels. And we do find that weaker firms weaker listed firms benefit more from the suspension, which is another piece of evidence that is consistent with the competition explanation. So before I talk about my comments, I want to just share some of my thoughts on the big picture. I think that this paper is related to the access to finance literature, especially in the emerging market. We know that access to finance has remained quite challenging in many emerging markets. In China, there's a very long queue of IPO applications. To give you an illustration, so today there are about 4,000 firms listed in China in both Shanghai and Shenzhen. And the length of the IPO applications, if we count firms at different stage of the application, can range from 200 to 600. So there are a lot of firms waiting to be IPO'd. And in the data, we do see that IPO withdrawals are very, very unlikely. So no approved firms voluntarily decides to withdraw the IPO, even during the very long suspension, as far as I know. So I think this implies that IPOs are very highly valuable for firms. This is their gateway to a very scarce access to public finance. And flip side of this is that the optimistic IPO timing, which has been documented in the US, is probably less of an issue in general, I think, in China emerging markets. So I think that these adverse effects of IPOs on already listed firms can be generalized to other emerging markets. I also think that such an effect is present in developed economies, but it's probably weaker because firms in developed economies, they typically have better access to finance. I think in terms of welfare implications, I view this competition that this paper documents as leveling the playing field for firms with and without access to the public financial markets. And if we think about it from this perspective, then the IPO suspension is basically halting this leveling the playing field, which has negative consequences to ensure equality of the market. So this is some of the big picture thoughts. Now, let me dig into how should we think about the empirical setting. So as I have already mentioned, this setting has clear advantages to overcome the endogeneity concerns. First, the authors are using those that are already approved IPOs, that all of them are eventually successful. So this helps us to sidestep the selection issues of IPO. And second, this imposed delay in listing is exogenous to not only firm and industry fundamentals, but also exogenous to the industry level variation in market valuation. So I would like to argue that since this setting explores the variation in the actual listing itself, how it affects the two competition channels is also different. I would argue that direct competition, as far as direct competition is concerned, the competition is already pretty intense before the actual listing, and the listing itself further intensifies this competition. And as far as the second competition channel is concerned, the asset-based competition, I think that listing is indeed necessary for this competition to take place. So now let me first talk about the first competition. So I want to point out that listing in China has requirements on profit, cash flow, and net assets. So this is a summary of listing criterion that I take from the Shanghai Stock Exchange, which also applies to the Shenzhen Stock Exchange because these are basically CSRC requirement. So as we can see that in order to do an IPO, the company has to make continuous profit for the last 3 years, and there's a minimum cutoff for the profit. You also need to generate positive net cash flows, and as well as having a certain threshold in terms of intangible assets and net assets. So this means that these unlisted firms, if any firm that is currently unlisted, it wants to do an IPO, it first need to perform relatively well, so it needs to be profitable. So the product market competition between those firms that already obtained IPO approval and the listed firms is presumably already quite intense. So I think this is probably something that can be different from the US, because we know that in the US, a lot of IPO firms are not already profitable at the time of IPO. But in China, all of them needs to be profitable to be IPO. So how would the actual IPO increase this competition? I think there are several channels. The first one is that actual IPO raises finance. So it helps the Q firms to loosen their financial constraints. And second channel is the certification that a firm receives by the process of IPO. So certification can be provided by the actions of several entities. First, there are a lot of financial intermediaries that are engaged in the process of IPO, so underwriters, investment banks, law firms, and auditors. And second, since the firm needs to get CSRC approval, this CSRC approval can also be viewed as certification by the CSRC. And lastly, when a firm eventually does the IPO, its market performance can be taken as a measure of how much certification the firm does. So in this setting, since we only look at those who are already approved, so I believe that the first two channels, underwriters and sectoral as well as CSRC, affect both the firms that have been approved and not subject to the suspension, as well as the firms that are subject to suspension. So the certification that actual IPO provides mainly comes from the IPO performance. And lastly, by doing an IPO, the firm becomes much more visible in public eyes. So this may also help the firm improve its profile and gain more advantage in its product market competition. So I would encourage the authors to think about how to test these three channels. So here are some of my suggestions. So I think the loosening of financial constraint, my conjecture that is actually a big one. So this can motivate another heterogeneity test, which is the following. So because these IPO approved firms, they have already submitted certain financial statements and IPO prospectus. So we can actually measure the extent of financial constraints by this. So I would think that listed firms competing with more financially constrained postponed firms should be better off, because if these postponed firms can do the IPO, the financial constraints are elevated and the product market competition advantage should take place. So this is one of heterogeneity tests relating to the loosening of financial constraint. Second, I think that I'm curious to see whether the listed firms take advantage of the halt of IPOs and do season equity offerings themselves. Since now they face less competition in raising capital, some of them may do this to take advantage of this. And second is the certification from IPO performance. I think we can examine heterogeneity of these effects with respect to the price earning ratio at issuance and the first day return or later market returns of these delayed IPOs, because these measures can be viewed as certification from IPO performance. So I think the heterogeneity test can speak to this certification channel. And lastly, there's the visibility. So one way to measure visibility is to use online search index of these firms. I think that there is also a distribution of visibility increase, which the authors can exploit. So these are some of my suggestions for the first channel, direct competition. Now let me move to the second channel, which is asset-based. I think the assumption of these asset-based competition is that markets are incomplete, which is, I think, generally true, but especially relevant in the Chinese settings. I think to test this channel, the key is really to identify already listed firms that will be affected by the market completion force from the IPOs. The current measure is based on the covariance, which corresponds nicely to the mean variance optimization. But this measure also uses industry affiliations, which are already used in a direct competition measure. So I wonder how correlated is this covariance-based measure that use industry affiliations with the direct competition measures. So if there's some spurious correlation there going on, I think what the authors can do is to construct alternative measures by dropping all firms in the same industry and reconstruct this measure. And also, I would suggest to explore other aspects of the asset-based competition. For instance, we know that retail investors, as well as some institutional investors, they tend to exhibit local bias in their portfolio choices. So I wonder whether you can rerun a test based on these local bias by examining synthetic portfolios based on the headquarter locations. And also, we can differentiate stocks by level and type of institutional ownership. So for instance, certain mutual funds can have specialty in IPO stocks. So stocks held by these funds that have a higher exposure to the IPOs. So these dimension of variation can also be used. I also have some additional suggestions for the outcome variables. So currently, the paper focuses on the one-day return. I wonder, I think that this can be broadened as well. So first, we can take a look at longer horizon. So Frank has mentioned that the suspension decisions are probably in reaction to some market movement. So we can purge that out by calculating the abnormal return, cumulative abnormal return. So another test to verify that the suspension is unexpected is to see that the pre-suspension returns should be insignificant. And also, we may be wondering whether there is any drift beyond the suspension day. Since a lot of the direct competition channels would take effect in a longer horizon than one day, so I think it is interesting to see the operating performance of the listed firms. And also this is related to the longer window as well, because maybe not all the effect will be captured by the market in the first day. And also in terms of asset-based competition, trading behaviors, institutional ownerships can also be examined to shed more light on this. So let me conclude. I think that this paper not only contributes to the IPO literature, but also contributes to the access to finance, especially in emerging markets literature. The suspension of IPOs in China provides a clean setting that has many advantages. I want to note that competition dynamics do interact with this setting. And I would think that more analysis, especially on these competition channels, would further solidify the competition channels. So overall, I really enjoy reading the paper. I hope that my comments and thoughts are useful to the authors. Thank you.
Thanks, Tianyue. Frank or Mark, would you like to respond quickly? And then before I turn this over to the audience.
Mark, shall I just take a few high-level points and then turn it over? Okay, well, first I just want to thank Tianyue for a very rich discussion, and there's a lot of points in it that we're going to go back and look at. We're talking about how other measures we can look at, and she did a really great job in explaining the whole process. I think we may rely on some of those slides going forward. I think that it's quite clear, explaining our paper. And I really like this point about access to finance, how we can frame our paper, sort of a financial inclusion paper. And I know that was sort of in there, it was in our economics letters piece of 2016. It's sort of like, isn't it a shame firms are not getting what's the cost to this? And I think we can bring that out more. I think it does. China is a great example for emerging markets. And what's interesting is what I thought when you made that point, Tianyue, I thought of the Brown and Lorraine paper, really the classic paper about the assets-based competition effect. And that's really focused on emerging markets. And they're saying that that's the right place, the best place to test for this. And so when you mentioned that point, I thought that was quite helpful. Just one more point before turning over to Mark. I guess the SEOs, that's a great suggestion. Whether there were any SEOs by currently listed firms. But just my impression, but we can go back and look, and I may be wrong, was that these suspensions also coincided with suspensions of SEOs. But we can go back and look at that and whether that was in fact the case. And if it wasn't, that's really a great thing to be looking at, in terms of the competitive dynamics. So, yeah. Mark, over to you.
Yeah, thank you very much, Tianyue. That was a great discussion. I think we learned a lot from that. I just would comment on a few points. I really am sympathetic to this idea that there's more that we can do in terms of teasing out other dimensions of the heterogeneity, in particular of the competitive channel. And so your ideas were great. And so we have to think a little bit more about that. In particular, as you're saying, the first one about firms having more or less, and the way we'd have to set it up, as I'm sure you understand, given your discussion, is that it's going to be by industry in the queue, the firms. So it's going to be kind of like the firms that are in your industry, are they more financially constrained? And then it's kind of interesting question, because what is the norm for the industry? That might be something that systematically differs across industries, and indeed the financial needs of firms might differ systematically by industry as well. So we have to think a little bit carefully about, it might not be a common benchmark, but there might be something we can say by industry in terms of identifying industries where the group of firms that are in the queue awaiting potential IPO at the time that these blanket decisions come down are more financially constrained than firms in other industries. But within our framework, that would be the way we could tease out that kind of a question, and the other things you identified as well. The other comment that I really liked was this idea of a potential problem with our results in terms of the covariance tests, and the idea of dropping the firms in the same industry to eliminate the contamination from the competitive effect in terms of isolating the covariance effect. That's something we haven't tried. I think we did try a placebo. I'm not sure if it's in the current version of the paper, which you also recommended, but given that we tried it, we're certainly sympathetic to that idea. But I think that the first one was something that we hadn't thought of, and that's very useful. And I think we'll do that in the next version. So thank you very much for those helpful comments.
All right. So thanks to the presentation and discussion. I don't see any questions from the audience. If you have any questions, please feel free to raise your hand. I guess Junko has a question. Junko, you can turn on your camera if you can. Okay,
so
Junko, please.
It's very interesting paper. So Frank, I have just one question about this. Why government actually suspend this IPO? Because you have 3 different suspension, right? I'm not sure whether they have same purpose for this kind of different suspension, or maybe the last suspension you show, I see that actually the market price substantially increased before suspension, then it dropped significantly, right? So maybe that the last suspension is motivated by maybe cooling the market overall to a certain level, right? But I'm just wondering whether when you do those kind of analysis in different suspension, you may end up with the same kind of results, or maybe the results are different depending on government motivation to suspend. So that is my questions.
So if I may add to Junko's question, what I had in mind is something about the queue, the IPO queue. So the suspension may also reflect what is in the queue, right? In the sense that maybe the government would like to pull down a certain industry, and that industry is overrepresented in the IPO queue. So that can also speak to Tianyue's competition concern, right? Because it could be that these are industries that are too competitive, and therefore the government is trying to reduce the competition in that sector. So I think these are all, you have the time series component, you have the cross-sectional variation. So I think we need to understand this a bit better. Maybe the management science paper helped, but I haven't read it. So.
Right.
So
Go ahead, Mark.
Well, I'm itching to answer Junku's question because I think it illuminates a strength and a weakness of the paper. I think the basic idea of the setup and is that I like to tell people this is a paper that's not about China in a way, and that we're trying to speak to a more general finance question using Chinese data. And so if you want to play the game that we're playing in this paper, you really have to be willing to dance with us in terms of the pooling restriction that we're going to make across these IPO events. So we're going to stick in, a time dummy that's meant to capture all of the effects of the blanket IPO on the average fortunes of the listed firms. And so in a way, your question is almost inadmissible because we're kind of dumbing it out to get at this question of what can we identify in the cross section. But there's certainly a number of super interesting questions, and Frank said we did a letter on this years ago about what's going on in the big picture of the macro question of doing a blanket IPO of that type. And this also gets to Johan's question as well about the CSRC claimed that they were trying to, at least in the first two IPOs, Frank, you correct me if I'm wrong, they were trying to address impaired equity values. So they thought that equities were falling below levels consistent with fundamentals. As you probably know, in both cases, this was a fall off that was following a huge run up in equity prices in China. And so whether or not that was true was a different question, but they claimed that they were responding to overall market conditions. But it's certainly possible, as Johan's question could be, that they were responding to something else, like the competitiveness of the firms in the queue, or something like that. More as if you look at Frank's, I think Frank's the time chart that Frank showed. In every case, the prices are going down before the suspension, but it's not in every case that it works in the sense that then they go up. Only one, I think.
Yeah, I think in 2015 it definitely made things worse, and who knows, maybe and then we in our letter, which we may want to take a look at, it's at Mark's website on San Francisco Fed. We just document that these suspensions really weren't associated with the stated objectives of the regulators, and the regulator in charge at the time of 2015, we mentioned in the footnote, his career didn't do too well after that. But there's also it's not just 3 suspensions. There are many more, and the Song and Howell look, I think, are at 9. They go back. 2015 was the last one, but they go back much further. But we just have data constraints. We can only put together a full set of data for the last 3.
You have some really peculiar years. One is 2008 to 9, and then the other one is 2015. So if you just isolate those, what do you observe? I mean, the 0809 is definitely different from 2015, right? So do you have any information on those specific years' behavior?
So we report those. We're hanging out our dirty laundry, and indeed the overall returns are quite different for different announcement days, at least in terms of the one-day returns. But I think, as I was saying before, we don't want to play that game because the spirit of this paper is that a lot of the existing literature has this problem of the endogeneity of the IPO suspensions. And so, what we really want to do in this paper is get all that out of there by pooling across these various interactions and then look at the action in the cross-section according to the differences in exposure to the queue by firm industry.
But my thinking is not about the market timing or those kind of stuff, but it's about this three different, like you point out you say that there are three most recent suspensions, the 08, 09, 1214, and 2015. Each of these are motivated with very different economic and political reasons. And what I'm thinking of is really about not the market price, but how the economic market, the competitions and all this fare up in this suspension. And then the other thing is I also want to know, like, what happened to the labor market in those days? I mean, 08, 09 is a very peculiar year because of the crisis and then the big pushing of monetary stimulation. And 15 is definitely about that someone make a decision the politicians do not like and so on and so forth, right? So I'm curious on what happened in the real market as well as the competition effects that you highlight.
Yeah, well, we show the average responses in that picture that Frank showed. And the answer is that it's a mixed bag. And maybe it's a mixed bag precisely because of what you're talking about, because the suspensions were motivated for very different reasons. And so, I'm sympathetic to your comment, Bernard. Yeah. Frank,
Thank you.
You want to add anything?
No, good response. I said, we could talk more about each of, give a little more detail about the environment around these suspensions. Of course, we did that in the letters, as Mark pointed out. We're really focused on the cross-sectional differentiation in firm performance, and we're trying to dummy out the idiosyncrasies of each suspension event. But let's think about that. And thanks for the comments.
All right, so I think we need to wrap it up because it's noon here in Singapore. Thank you all for the wonderful presentations and discussions. Thank you to all the discussants for spending time reading the paper. I've heard positive feedback from the discussants privately of the paper, so I'm very appreciative of those. This is the end of the conference, right, Bernie? For this year, this is the very last one.
Yeah. Well, then we'll have the fellows meetings later.
Okay.
Randall, you.
Yeah, thank you very much to all the presenters and discussants and to the organizers and to you, Johan, for running everything and keeping us all on time. It was a very good group of papers. Thank you very much.
I also want to thank the program directors, Randall and Junko, and also the conference organizers, Angie, Nelson, and Johan. You all have done a great job, and I enjoyed the papers very much. Thank you to all for the authors. Wonderful presentation, stimulating paper, and the discussions. You all have done a great job. We are very grateful for your support, and we sincerely would hope that next year we can meet in person, and I for sure would do the best I can to see if we can host a dinner and with a good glass of wine and some good food and so on. And so once again, thank you very much. And also, I want to thank the ABFER team. Like, I know that people were working until 1:40 last night. Frank knows that very well. And then they get up, they get started again at 8 this morning. So it's just, I'm very grateful for to the team for what they've put into. All in all, thank you very much. ABFER is forever grateful to all your great efforts and great economic research work. Thank you.
And thank you to you, Bernard. Good night, everybody.
Thank you.
Thank you.
Thank you.
Thanks a lot.
Thank you.